Now I would like to request the speaker of the day, Sabrishan, to give his talk. I think it's a very important subject and most useful subject, and Sabrishan is quite eminently qualified also to give that talk. Before that, I would like to ask formally, Sabrishan is well known to all of us, but I would like to ask our President-elect Shankar to formally introduce Sabrishan.
Good evening, everybody. It gives me great pleasure to introduce Rotarian Sabarisan to all of you today. Rotarian Sabarisan graduated from Bangalore University, qualified as a chartered accountant in 1998. Post-qualification, he worked with Deloitte in their Bangalore and Mumbai offices for about 15 years. He was a national topper in the CIA examination and is also CISA qualified. Correct me if I'm wrong, Sabarisan. These are alphabets which I'm not familiar with, so I'm hoping that I'm right. Sabarisan has been a speaker at professional bodies such as ICAI, IIA, and CCH seminars on topics relating to SOX, ERM, internal audit, and fraud risk. So honestly, I have no idea about all these alphabets that Sabarisan specializes in, but I'm sure that they are very, very intense, complex financial stuff. Personally, Sabarisan, like Bharat said, is a go-to man for most of us. Whenever we have a doubt, Sabarisan, I can pick up the call and check with Sabarisan. And Sabarisan has always got an anecdotal way of of explaining to you. So it makes it very interesting the way he puts it across. So I'm very happy to present Rotarian Sabarisan to all of you.
Yeah, thank you, Shankar. And I think it was CA exam, not CIA. I think that is probably a typo. But even if he was in the CIA, I think he would do well. So anyway, over to Sabrishan.
One second. Thank you, Shankar. Kind words. Thank you, Bharat. Rashmi, can we have the screen? Yeah. So I'll keep it simple. People, stop me in between. We may have at least two questions which will come up as a poll. People can respond. See, frankly, I have been more of an auditor CA rather than, investment guy most of my life. So there's a lot of risk and caution comes in most of my thought process. One. And what I've seen is a lot of people seem to do a lot of right things. They build in money, but saving and conserving, I think there is a lot of problems. So primarily this entire discussion is all going to be about, post earning, what you do with money. We're not going to look at how people have made their money, and all that is not going to be the criteria here. We're going to basically try to focus to say, having earned it, how do you preserve it? How do you grow it? Okay, that's going to be it. There is some personal tinge. I have been very lucky enough to have, met a lot of people who helped me and create awareness into a lot of financial instruments, and especially being an investor in the stock markets for quite some time. I started at the age of 15 investing in the stock markets, and it's been a great journey, I think. So some of it will have a personal bias towards the stock markets. Rashmi, the next slide, please. So what to expect in this full thing? I think, some of it will have a personal bias. There's going to be no ground rule to say do this, do that. It's more of an awareness kind of a thing. I expect this entire session to be more of a catalyst, and I think it will be very interactive if people were to participate and share their views. I also gone with the assumption that people already have worked about close to 20 years plus after their first jobs, and they're about 45 plus, so there is a lot of money available for them to invest. Okay. Maybe at this point, I just want to put a poll for some people so that they can answer. I mean, they can just give their views so that we just see what does it look like. Yeah.
It's about 45 seconds.
So this is good. More than, I think, close to 3/4 of the people check their portfolio, or at least review their portfolio. Check is a very basic rudimentary thing. Someone did ask, what is a portfolio? So I meant it's like, the basket of wealth people have created. Having said this, I have another question. Would anyone want to get onto the chat and, put in things like, what do they mean by wealth? What does wealth mean for people? Anyone wants to go? Yeah, someone has put in something. Okay. Sundar says it is net asset after liability. Okay, that's a good start. Bharat says financial independence. Okay. Sarangan says assets created. Cost breakdown is confusing. Where is living cost, rental, etc. Okay. Mr. Rao, I agree with you. This is something which I pinched on the net. So cost breakdown is it's not Indianized. That's perfectly fine. I agree with you. These are costs which are not added here. So we do have various versions and various thought processes on what is wealth. Okay, I'll just go to the next slide and why we are discussing all this. See, what we will be discussing today will be what does wealth mean? Someone can amplify it, all that is fine. The power of compounding, how starting early makes a lot of difference. My personal experiences on equity and some of the thoughts of very senior investment managers who run mutual funds of billions of dollars, some of them, some key words here and there. There's a need for capital allocation. What does it mean? In a very simple way, I've tried to make it something which is even non-finance people will understand. Age as a factor, I've just put in this. Okay, I will, when we come to it, I'll explain. A summary is basically a summary of all of this in a single slide in some simple way to help people understand the entire message in a single slide. It's like putting everything in one single slide so that you just look at it, you get a recall on the entire thing. We could have Q&A as we go along. We'll start with what is wealth. Yeah. Okay. So basically, whatever we save today, in economic terms, savings is basically postponement of expenditure. That means if I save 100 rupees, I'm going to use it for spending on something else. I save money to buy a home. I save money to buy a car. I save money and buy a phone. Or in today's world, it would be a reverse logic. People buy on installments. Basically, you get the immediate gratification. You spend it immediately. And then you keep paying it in installments. Okay. Now, the interest is lower than the inflation rate, you actually are not saving money at all. So if your FD is getting you 7% return and the inflation is 8%, you actually lost money in that full year. And the difference between rich and wealthy, I've just given two examples there. There's someone who's earning a lakh rupees a month and a bank balance of 10 lakhs. This is someone who's rich, he's earning, he's spending as well. Whereas someone who's earning 50,000 from salary and another 50,000 from investments, irrespective of the balance, is a person who's wealthy. Basically, wealthy means what happens is you start deploying the money and multiplying itself. So way back in Rome is where the concept of interest for time started. Okay. So when someone lent money to someone, you paid interest for the period someone used the money. So whenever you get your money to work for itself and grow, you're creating wealth. And here I just would want to add that, look, higher the risk, higher the reward. I have not put it in print here, but this is how it works. So earning a lakh rupees is rich. Wealthy means you have a lot of income which is multiplying on its own. So you have the time to reflect upon, maybe someone's getting rental income, someone is getting fixed deposit income. So when you keep putting it into assets and it grows on its own without your physical efforts, your primary earning thing, like I'm a CA and the money is growing parallelly, you're creating a second stream, you call it wealth. That's wealth creation per se. Any questions at this stage, you can please let me know. If someone's got a counter view on wealth or richness is more associated with more of an expenditure and a lifestyle. It's more of the marketing guys trying to say that you need to have a big car, a fancy phone, and God knows what and all that. So rich is all about spending habits. Wealth creation is about investing to make it grow on its own and creating a second, third source of revenue which will grow on its own. Yeah, Rashmi, can we get to the, any question?
No, suppose somebody is not earning an income, but is living off savings, but has no liabilities. How do you define that person?
Sir, he is retired in life, sir.
No. In terms of rich or wealth?
No, he's got wealth to take care of him. No, so he doesn't need to work at all. He built, he's earned it in the 20s. He's now living it off in the 70s.
Depends on how much he's getting. Now, it could be hand to mouth also.
Now, this question, we should take it offline.
Okay.
So I will put it in a perspective. If I get paid fees for it, I will answer that question.
Okay. No. Also, is there any philosophical basis to this, in the sense that somebody who's earning a lakh may have an expenditure of 1.2 lakhs, and somebody who's earning 50,000 may have an expenditure of only 20,000. So who's wealthy in the two?
A person who did the differential to earn more money is wealthy, getting wealthier. See, we started this entire thing to say people are in the age of 45. So they have already crossed that cusp of age where they've now started earning more, which they need to save, because lifespans have increased now. People are going to live till 75 or 80 nowadays. So you need to even retire at 60 or 65. You need to have money for the next 15 more years.
Rotarian Mohan Rao has a question in the chat, if you can address it.
Yeah. Sir, HNI or an ultra HNI is someone who's got a lot of surplus wealth already created. So maybe let's say someone like a Nandan Nilekani has got a lot of wealth, okay, and he would be an ultra HNI. And this deck of presentation may not be for an ultra HNI. This could be for a regular HNI on why they need to monitor and a very basic stuff. This should be very basic because they would have fund managers. Like an Azim Premji would have his own fund managers at all. That would be a very different way of putting things. And to say if one ignores the mental state of wealth, my call is net investable surplus. Yeah, I agree. Whatever is the net investable surplus is what will go into creating wealth. So Bharat, to basically Mr. Mohan Rao also answering the question to say that unless you have a net investable surplus, you're not going to be creating wealth. Hello? Hello?
Sabrishan, we can't hear you.
I can. Hello?
Who's saying hello?
Yeah, I'm saying hello. I can
Oh,
hear.
okay. Yeah, okay, fine. Please continue then.
Yeah. So I will move on to something called the power of compounding. Just give you a very simple example. Somewhere in way back 1600s, the gentleman Peter Minuit actually bought the entire Manhattan, okay, for about $24, okay, and even if they had invested in the $24, I'm saying in an 8% bond, it would be worth about $26 trillion, which is could have bought the entire America, right? So people tend to forget the power of compounding. I'm just giving a simple example. Let us assume someone put in 70,000 rupees a year in something called a PPF, which is anyway interest free 8%. At the age 25, instead of going it at 35, okay, by the time they turn 60, you will have nearly more than double. See, the age is only about 10 years difference between 25 and 35, but the money is compounded so much that you'll have more than double just for a 10-year difference for the same amount of investment. So it's very, very necessary that people start earlier and ensure that the money actually gets monitored and multiplies. This is universal. No two things about it in terms of the fact that the earlier you start, it multiplies. Okay, and I think it's very simple mathematics here. Rashmi, next slide, please. Yeah, I'll take a little longer time on this in terms of investment in equity. These are my personal views and all that. What I would recommend when we have an investable surplus, I would say please start with mutual funds. And I would recommend that instead of equity, if someone's very cautious, could put into index funds in mature markets. It's very difficult to beat the market actually. And in India, we are heading there. We're going to become a mature market in some time. And generally in an index fund for something like about a lakh rupees, I think the cost of managing is about 0.02%. So at 200 rupees for a lakh rupees, I think it's just the cheapest way someone can manage your funds. There is something put in blue because this is something this is just a offhand thing. People have started now owning paintings on a fractional ownership. I'm putting this here just to give an insight into how, maybe in the 80s, what happened is when mutual funds were new, Unit Trust of India was the only agency which gave units. The market today is maybe 1,000 times bigger. When the market opens up and a lot of people come in and a lot of people start saving more and more. Instead of putting traditionally FD, they put into mutual funds. The market grows manifold. Similarly, today, maybe at the cusp of start is something on paintings. People are experimenting it in places like Singapore, where they're saying very costly high-end paintings will be owned by people on fractional ownership basis. And going forward, it could become a way of owning paintings. See, we are seeing this happening in a lot of places, including, let's say, whether it is apartments is basically a fractional ownership of land. That market has reached some stage in urban cities. Similarly, there will be a lot of appreciation in this. This is a high risk thing. I'm not recommending it to anyone. I'm just giving a perspective to say that equity is not for the faint hearted. You need to go through a lot of turmoil. I personally, hold on to equity for minimum 5 to 7 years. Anything less than that, or 5 to 10 years, I don't even get into investing in equity. Now, why equity doubles always? I will just want to put it in this way. I think a lot of people must have heard about Mr. Modi saying we're going to grow at 14%. So generally in economics, what happens if you grow an economy at 14%, 70 divided by 14 is 5 years. That means the entire economy doubles in about 5 years if you grow at 14% growth rate. This is what they had predicted or planned pre-COVID. Now, what happens is if you're an investor in a company and it's really doing well, even at the economic rate, if it grows, okay, then what happens is you doubled your money in 5 years without having done anything at all. I'm thinking even the company did nothing, just based on the economic growth. If they grew as per the economy, they would have grown double in 5 years. Now, where the beauty of equity investing comes in is, suppose a company is growing at 30%, 72 divided by 30, I'm telling you in about less than just about 2 years, you may have actually gone double. So why people actually see super returns or better than normal returns is, unlike debt, which is very static, in equity, if the company is bettering the economy, it's just more of an insight. If let us assume that the economy is growing at 5%, 7%, and this year we are talking of a negative growth of 10%, and some companies are saying they're going to grow year on year at 20%, then you know very clearly, just because of the growth itself and if the PE value is going to be same, your investment is going to double depending on the growth. So I have a personal bias towards maybe consumer businesses, because I've done a lot of audits around consumer business, and I feel there's a lot of stickiness and it generally is stable. It is not very wavery. So people who are investing look at certain sectors, like for example, airlines. Today, the industry is growing at 30%. Okay. So if people are investing in an industry which is growing at 30%, and subject to pre-COVID, I'm just saying, if you just keep aside COVID, and a couple of years down the line, you will have all the smaller airports also connected. And with COVID, there is also a belief that, if the airports are the only clean way for people to travel, more and more people would want the comfort of an air travel. So maybe I do these kind of an analogy where I just try to look at more on the consumer side. Okay. And I would say, anyway, this is not a call for investing or not investing. I'm only giving some broad guidelines. One, I only want to be a little extra cautious with everyone saying that please invest only for the long term. Okay. Now, having said this, I have put in names of two people whom I have been tracking, and I read a lot of stuff based on what these two gentlemen put in. One is Saurav Mukherjee. He's written multiple books. I've read most of his books. He used to earlier be with Ambit. Okay. So he has put in something very clearly to say, please put in money only in companies which focus on capital allocation. He gives a very significant premium to something called allocation of capital. I have a separate slide for it. I will run through it. I have highlighted the word integrity because what happens is some company managements are not known for their integrity. It so happens, like for example, you have Crompton Greaves. There's a diversion of funds which happened. Z Telefilms. A lot of companies which have gone down under is because the managements have diverted money. Okay. So Saurabh actually says you never should invest companies which have the management lacks integrity. Okay. Having said this, I would also, Rashmi, can we have that question, and just want to get a sense of, let us assume there is big money to be made. Would people want to invest just because there is money, or integrity would come into play? Because, not everyone in India has talked about integrity. Saurabh Mukherjee, from his Ambit days and all his books he's written, he's always concentrated on integrity. Marcellus is the only fund, to my knowledge, which has got a forensic division inside where they thoroughly go through the financials, because they believe India is not a very clean market. Rashmi, we can put up the second poll. I just want to get an update from people in terms of whether they're open to investing in companies with not so great accounting practices.
Yeah, just a second.
Yeah, that's fine. So I will only want to say there are two things here. One, either all of you have been very lucky, or there's no one who's honest. I will tell you one thing, frankly, I myself would be in the first category, saying that when I started off in college days, I must have invested enough and more on tips, maybe made money on some, not so much. And I think someone who's put in maybe, or the couple of people who put in maybe, maybe I would still say it needs a lot of wisdom to stay clear, but it's very, very tempting to keep investing based on tips. Most of the market runs that way, very addictive. And I must have lost money and then realized it, but that's fine. I think, we have, yeah, we'll close this poll, Rashmi. Yeah. Okay, next gentleman I would want to refer to is this gentleman called Naren Sankar. He is the investment manager with ICICI Prudential. See, he started off investing his father's funds maybe at an age of around, I think, 12, from what I've read. Okay. Now, all of us come with certain biases. Like Naren Sankar is from Chennai and South Indian, tends to get carried away a little bit with a lot of thought, not on the the glamour side, but more on, tends to believe a lot of people and tends to get carried away, right? So we do have it. Now, what I have done personally, picked up an idea from one of his, what he does is, for the last 30 years, Naren Shankar and a group of people in Bombay have a very serious group where they bounce off ideas on investments and get a second opinion on whatever they have in mind. See, Naren is way there on the top. He's been investing his dad's money from the age of 12. His dad's still around, a lot of big portfolio. But he still says, even with all this, somewhere, the learnings of all these years, he still seems to get carried away. And this group, which is where they bounce off ideas with differentially thinking people, is active today only because everyone derives value from it. I personally have formed some similar group with a group of my classmates, some of them who really are into serious investing and all that. And I think it's a tremendous idea bounce off ideas with people who think differently. And maybe when they bounce off ideas, you believe, oh, you missed out something, there's someone who's bringing something to the table. So I personally benefited a lot from these things. I think it's nice to bounce off some. One could be equivalent to 11. Okay, so Naren started discussions there. Briefly touch upon REITs, people who have a pension for real estate. I think they're similar to mutual funds, except there is no hassles. You have the liquidity angle to it. You can sell the real estate whenever you want it. Real estate has got liquidity issues. REITs are something which is globally successful, especially Singapore. And maybe it's at a nascent stage. We have 3 or 4 REITs in India as of now. And I think that would be something people who really want to have a shadow real estate investment with rental yield, they should maybe think about it. And I'll not get into specifics of why COVID has happened. Will commercial real estate drop and other things, or something which, yeah, we'll have to wait and see. You just can't predict. Okay. Yeah. We will, yeah, before we get on to capital allocation, just small announcement, see, last year, on 16th November, my birthday, the club, we had a club meeting, and I was delighted to be having a cake cutting kind of a thing. I wanted to do that to someone else today, and since it was Sundar's birthday, I didn't know Vinodji's already done the needful, but we also got a cake delivered. Sundar, are you around?
Yes, very much around, and I've just posted the cake. Thank you very much.
Can we sing a song for you now, or what is it? That's out of the meeting.
No, you can click the photo and you can see your cake. It has just arrived. I hope everybody can see the cake.
Once again,
I hope everybody can see the cake.
No, we can only see the
Screen.
PPT screen.
Oh, PPT screen. No, it's on the chat box.
Okay.
On the chat box.
Okay.
Somebody click it. There's an image posted.
I'm unable to see it.
No.
Just send it to Rashmi Sundar and she will.
Okay, done. I'm putting to Rashmi. Thank you.
I'll just share it.
Oh, wow. Yes, Sundar.
You can see it?
Yes.
There you go.
Oh, yeah. Wonderful.
So thank you, Sabri and Rashmi, for coordinating, and Swiggy guy was very, he came and delivered promptly within a couple of minutes of calling.
Yeah,
Thank you once again to all of our friends.
Yeah. Sundar, I felt very special. Okay. And maybe whenever such a thing happens, I think, some other member will do it. I think it's fine. We should just keep the tradition going.
Yeah, I recall 2 years back, Shankar and Usha did it for me.
Wow,
they came to my
great.
home and we celebrated.
Sure. Rashmi, we'll get back. Yeah, I briefly mentioned about, Saurabh Mukherjee talking about capital allocation, and a lot of people do this. See, Saurabh Mukherjee talks of capital allocation at a company level, and also I am putting it this way that people need to do it. I've just put a very brief example here. Let's assume, someone invested about 100 lakhs, which has grown to become 500 lakhs today. Okay, I've just given a brief hypothetical example. Someone has put in money into real estate with a rental yield. It could be land, building, whatever, and also the current market value. Now, why capital allocation is important is what happens is, one, when you invested the money 5 years, 10 years earlier, there was some expectation and there was a reason why the allocation happened between real estate, which is very illiquid, to an FD, which is highly liquid. Equity is also highly liquid, but with a risk angle to the full thing, right? Now, what happens is, over a period of time, if you don't look at it and you don't reallocate it to reach some goal of yours. See, that's where it's important. People need to have a goal in place to say, this is what we want it to be, and de-risk it, since I'm using the word de-risking it. So what happened, what you can see here is the original allocation was about 33% to real estate, 33 to FD, and 33 to equity. So assuming equity didn't give you return at all, you still were okay with it. I'm saying, equity is the only thing, if you see in this full thing, where you could have got wiped out to zero and you would have still retained 66%. Okay. Now, what I would want to say is, at a younger age, at 40, 45, people can take these risks and do a lot of these things. As they get older, you need to start having more secure and stable revenue streams. Okay. Now, the same allocation, if you put it at current value, it looks like 50% is equity, 40% is real estate, and 5% is FD. So let us assume there's a stock market crash, like the day the Prime Minister announced that there's a COVID, there's a lockdown, and the markets crash 50-60%, and or it just got wiped out or whatever. You suddenly realize you've not de-risked yourself on an overall basis. Okay, so that's why you need to constantly reviewing it with the overall goal in mind, and then slightly tweaking it. I'm not telling that someone should sell off the real estate and put it into FD, vice versa. I'm only saying there's a purpose when you started off. If the purpose is not getting met or there's some other deviation happening, it's better to correct it so that you mitigate the risk. Now, it's like this, I could make $1 million in a lottery, but I don't put all the 100 in a lottery, right? So I'm saying, just if you really want to do it, stop it and put a number to it and do it. I have just added in something from Mr. Peter Drucker. He said, if you can't measure it, you cannot improve it. So only what you can measure, you can improve. If you cannot measure, this is what even corporates do when there are KPIs. If they can measure it, they monitor it and improve it. So what we call in financial terminology is very clearly, if you cannot measure it or you cannot count it, there's no point. So necessarily you need to have this capital allocation as a process ingrained into it. Some could do it once in 1 year and things like that. Having said the review part, I think people need to, at some time, slowly will get to decluttering and not looking at everyday news channels. Reading newspapers every day and all doesn't help. So this also helps that only once in 6 months or once in 1 year, you reallocate the portfolio to meet your overall goals or the directional which you had planned for originally. Yeah, Rashmi, next slide. This is something which I put it in. It's not directly relevant with this. I look at it from a perspective of whenever I look at companies to see how old or young is the management. Is there a second level? Are they proving themselves and things like that? We have also seen a lot of people. I've given 2 examples in the bottom. I'll come to that. When I say lead by example, what happens is a lot of people who have been successful in certain things at a very young age continue to want to hold on. They do not want to give up. See, unlike a salaried employee or someone who retires at a particular age, an entrepreneur never wants to give up control, right? And they keep thinking of new ideas. So at 70, someone shouldn't be thinking of saying, I'm going to now start an e-commerce company and things like that. So it is just keep away from those kind of things. Please look at this from a company perspective. Okay. So I have just put in some things which are keywords which tend to give a message that people are not wanting to give up. They want to hold charge. Okay. Having said this, I will have given 2 examples in the bottom. Okay. One is Mr. Ashok Soota, who started Happiest Minds as a 3rd stint, with a great stint at Wipro. And after Mindtree, he quit Mindtree and then he started Happiest Minds. Now, Ashok Soota was already past 70 when he started and recently did an IPO. Now, Ashok Soota is a very different example. One, because he did the same thing what he did in Wipro. He built Wipro Tech from scratch. He built Mindtree from scratch. He did the same thing. So it's like, someone who is maybe a person who's a sculptor, or a school teacher who actually helps people, or a coach, let's say a sports person or a coach who helps people train, he continued to do the same thing. He didn't do something fancy and new. He did the same thing, maybe brought in a little tinge of his past experience to fine tune Happiest Minds. Having said that, if you take the example of Aditya Puri, see, he was the CEO of Citibank, I think, in Malaysia and Asia Pacific at the age of 45, quit to join HDFC. And 25 years at HDFC, the biggest bank in India in terms of value. He keeps himself busy by joining Carlyle as an advisor to the India CEO. He's not got a full-time job. He doesn't want to work. Now, he is behaving his age, right? So I'm only saying very clearly, it's necessary that people get into it. Maybe at this stage, I know it's a wrong question or something. Maybe Mr. Mohan Rao can come in. I have some views on this. So maybe since he's been in industry, he's been the CEO, is driven from the front, and now he does consulting for a lot of companies who are in the luxury retail space as an advisor. Mr. Rao, one simple question, maybe would you become an entrepreneur yourself at this stage, even if someone would say, I'd give you stock options or sweat equity?
Sometime back,
Yeah.
Maybe a few years after I left Himmat Singha, I have very strong close family connections with Italians and French in Italy, and who all are in the luxury space, whom I knew for decades.
Right.
Who trusted me. And then they said, looking at how Europe was functioning in terms of one of the basic problems is, manpower costs, availability of skilled manpower. So, and they had been dealing with me for decades. So they said, Mohan, why don't you look at starting up something in India, a top end luxury space. We can put in, there was about 5-6 of them. I mean, top names of people in there. We can put in about 100 million euro, 100 million euro is a decent amount of money, but then you have to be the MD. I mean, you have to look after the whole thing. Number one was, I just got away from full-time responsibility and I wanted time for my own, and I know the amount of attention something in this space takes. It wasn't conducive. I mean, it didn't suit me very well. And also because both my children were already in separate fields, and if you want to be an entrepreneur, you own. So if you own, you have to leave something for the next generation. If the next generation is not interested, what do you do? I see a similar situation happening to an extremely close family friend of mine, 30 years plus. Our daughters got married in the same year. He's also he's having maybe a decent, very, very decent entrepreneur from Bangalore, high-end electronics and stuff like that, about 200 crores plus. But then he wants to get out. He's 70 plus. He wants to get out. Both his children are not interested at all. And it's a very owner-driven, very thing that is there. His thing doesn't have a formal marketing setup, stuff like that. That doesn't. I think you more or less said what I said. People like, but I do advise people, but then I don't. I work, even today I was on a call for a couple of hours with with a large textile group, but then I don't charge money now. I don't need money. I mean, I only work with friends, and it's I don't need the money. I don't charge money or anything like that these days. It's fun, more myself to keep myself a little mentally occupied.
Sure.
That's it.
Yeah, thank you, Mr. Rao. I would just want to add something from an investment perspective. A couple of years ago, Sun Pharma went to acquire Ranbaxy to make it a huge enterprise. Actually, didn't behave their age. They were already a mature company. They acquired some company which is very large. Publicly was a lot of tamasha, but then they lost 80,000 crores of market cap for doing all the wrong things. I mean, Sun Pharma even today is a 2 lakh crore market cap company, but they didn't add value at all by going and acquiring Ranbaxy because they brought nothing new to the table. So sometimes companies acquire a lot of things. I think some of them don't add value. it applies in our individual life as well. I think it's better to stick to some amount of a discipline. Maybe market companies like IBM currently is now going to split into a new co and IBM Limited as well. That could be something interesting. We'll have to look forward. So the cloud is going to be retained with
Just two bits.
IBM, and the managed services is going to go out as a new co. Yeah.
I, it's also one of the things that happens. What I have seen where I have been on a few ARCs, from requested by the GOI and from big banks. And what I see, where companies fail, what brings them into that big mess is they grow, they want to grow big too fast. And the question is, they don't have the bandwidth. They don't have a managerial bandwidth. They don't have marketing bandwidth. They're doing extremely well in 80, 100, 200 crores. And they want to become a 1,000 crore company, put in huge expansion programs, and it's a different ball game in such space. My advice to companies which are doing well in a particular spaces, and which me and my CFO, who's also very, very close to me when we were in Himatsika together, we strongly advised, let's go buy up all the shares, let's be private, let's not have this constant tension of what I call the Q to Q disease. Every quarter, there's so much of paperwork, so much of this, the intention of senior people gets divested, from your core business. And unfortunately, the market today is only looking at the initial sort of numbers. It's not the whole long-term play. Is impossible. It's impossible to get it. It's impossible to run. If you get a new CEO, that poor guy requires at least 3-4 years to get a hold of what's happening in the company. And here, people are, expecting immaculate results. Anyway, that's my call.
Absolutely, Mr. Rao. I agree with you. Concur totally with you on that. Yeah. So what I've done is, thanks, Rashmi. We'll go to the last slide. See, what I've done is I've tried to put in a whole lot of all this into one single slide. The first one is tricky. What is too good to be true is not true. I always tell people that if you cannot check in print and regulation, and there are schemes, whether it is the Anubhav plantations to everything else, whatever is too good to be true is not going to be true. Please be very clear. People should not lose sight of this. Second, there's something called keep it simple, silly. Okay, there's an acronym for it. We also talked of capital allocation. So you need to have a way of monitoring. This is like having a garden for yourself. You cannot let weeds grow. You need to clean it up, and it's just about keep monitoring the investment. You need to, markets always reward the efficient capital allocation. Now, this is globally how it happens. If you have something of a weak capital allocation, you need to use those things and allocate capital. And unless you look at it and monitor, you're not going to act upon it. Age, we just now discussed. This is applicable to companies as well. And pedigree, age, and someone with a 25-year-old company cannot act like a startup. A startup will not have rules. It will have jugaad. They will do everything out of the box to survive and get it. But a big company should not do like that, because they're very different areas and very different pedigree. Passive income has to increase with age. When I say passive income, it means that you don't need to do anything. Or how I define, or everyone else defines passive income, is income which keeps growing even when you sleep, play, do something. So someone sitting in let's say on a holiday, but his money is growing. It works in two spaces effectively. One is on interest, because interest is running 24/7. For a borrower, it could be a sin. one, or it could be rentals. Rent yield keeps running in, even if it's holiday, no holiday, rental keeps going in. I didn't deal too much on expenditure, but I think in one of the examples with Bharat asked if someone's earning 1 and spending 1.2, I think people need to have sustainable expenditure. Deviations are bound to occur, but if you have a plan in place, you have some amount of a framework to say this is what my normal expenditure is, it is done. The last one is a little controversial. I put in some numbers and came up with a very huge number. I will briefly explain how I went about doing this. It says how much do I need to have at the time of retirement. So I'm now 48. I'm planning to retire, let's say, at 65. It is 17 years to go. At assuming ₹1 lakh of expenditure every month, you need about 12 lakhs a year. 7% inflation rate. That means what I'm going to spend now. And over a 17-year period, 12 lakhs will become 37.9 lakhs. That means, at the age of 65, you need close to about 38 lakhs every year just to lead the same lifestyle of today. I know it is hypothetical. You may have a lower inflation. It could be 5%, 7%, whatever. Fine. Now, assuming you're going to discount it, that means, if I need 38 lakhs every year and I need to make an FD at 5%, I need about 7.58 crores with me. And God forbid, if the rate of interest is 1%, you can imagine this will be 5 times this amount. I will need about 38 crores if I were to make only FD. So you obviously need to allocate capital to in different spaces. The downside, what is not put here, I will just want to say, I kept it in the last, not to frighten anyone, but to briefly say how serious this topic is all about. Okay. And I hope I didn't bother too much. Please sleep well. Have a good day. I'll wrap up now. Any questions? I'll take it up now.